right, let's talk about your passive investment strategy. When people cut their teeth in passive investing, they tend to go towards the tried and tested and what is talked about most often. And that, in fact, is a Nifty 50 index fund or ETF and a Sensex index fund or ETF. But the thing is, there is a question about whether or not you're taking the right approach, because there are options beyond these two index funds that give you allocation towards large cap, and that might actually give you a better return profile going forward as well. We'll talk about one such option and why it stands as a better option than the Nifty 50 as things stand right now, according to many metrics. I'm joined by Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. Chintan, thanks so much for taking the time. And indeed, we're talking about the Nifty Next 50 index fund or ETF, right? And first, before we get into this, let's talk about the various metrics that you would use to judge an index and the constitution of an index. If I were to ask you that, what would be the first few metrics you would list out?
Thanks, Alex, and it's been a pleasure to discuss the passive space in your channel all throughout, including the ETFs. On the constitution or the selection, right, when a passive product is created, it is essentially on an index, and that index methodology is generally well defined. The key ingredients of an index methodology which investors should look at should be what is the universe of stocks that that index is going to cover. You mentioned large cap names, let's say top 1 to 50 or top 1 to 30 large cap names. That's the popular index. Then there's a mid cap, there's a small cap, there are smart beta, there are sectors and themes. The universe is first defined. Within the universe, then the stocks which fit into those parameters based on liquidity criteria and otherwise are selected. And then you have a 30 stock, 20 stock, 50 stock portfolio as the case may be. And of course, we have 500 stock portfolios also which encompass the top 500. So when you're looking at an index, you should look at from a constituent perspective, what is the universe? How are the stocks selected? What is the way in which the weightages of the stocks are selected? And then, of course, the valuations of that particular index at the time of your investing. What is the future outlook based on the constituency of the particular index. Now, future outlook is, of course, very difficult for most of us to predict. But what we know is what is the universe and what is the sectoral weights that are there or the constituent weights and what is the methodology.
Okay, so let's talk about the large cap allocation, because I think, even if you don't talk about large cap versus mid cap versus small cap, you're talking about large cap as things stand right now. I just want to lay out what most people look at. People look at putting large cap index funds or a passive investment in the core part of their investment portfolio, right? This is something that forms the backbone or the foundation of their investment portfolio. So from that lens, what are the few options, Chintan, in the passive space that you could go through for a large cap strategy?
Sure, and Alex, beyond the fact that large cap forms the backbone of most diversified funds or even portfolios for investors, currently as the markets stand in India, 480 lakh odd crores of market cap, 338 lakh crores of GDP. At 140% market cap to GDP, of course, we are not cheap. But a large part of this expensive territory can be explained with the fact that we have only for 59% of our market in large caps today versus an average which is about 75 to 80. So large cap representation in the markets has reduced significantly because of the, let's say, overvaluation or the extra valuation that mid and small caps are getting today, which is close to 41% of the total market cap. So let's say the froth is slightly higher on the mid and small, so you should focus on the large cap side. Now on the large cap side, you have a lot of options when it comes to investing in passives. You have the large cap based ETFs on top 50 or top 30 names. You have also the Nifty 100, the Nifty 50, the Nifty Next 50, and many of the smart beta products also. For example, the Nifty 100 low vol 30 index, smart beta products which are on large cap specifically. So you do have a flavor of many options on the large cap space, which you can possibly look at from an investing perspective. The landscape is quite wide today because investors have a lot of opportunities. Many AMCs have various products on large cap. Even the NV20 is on the top 50 names, the top 20 stocks by valuation.
So that everyone's on the same page, what Chintan was mentioning, the smart beta strategy, is where you look at, and he told you how to look at an index. You look at a universe of stocks. A smart beta strategy uses certain filters that will then reduce the number of stocks based on those filters. So he just mentioned a low vol filter, that is a low volatility filter. It'll look at an overarching universe and then select a certain number of stocks based on the best performance under this one category, which is low volatility. You also have momentum, you have value, you have growth, you have various other filters that can then form parts of individual smart beta strategies. But Chintan, let's specifically speak about Nifty Next 50 and why a lot of people are actually saying that if you're looking at large cap strategy, look beyond Nifty 50. Why are they saying that? Is that because of concentration? And you also pointed out that the Nifty 50 and the large cap weightage has actually dropped quite considerably if you compare it with the overall market cap.
Yes, so the Nifty, the large cap weight itself has fallen, and a large part of it is to do with the fact that the mid and small caps have done well. Now, if we look at the constituents of Nifty and Nifty Next 50, so put together, what is Nifty Next 50? It's essentially the 51st stock to the 100th stock. If you compare it and if you look at the past 10 years, there was a period between 2016 to maybe 2020 or 2014-15 to 2019-20, where the 51st to 100th stock did exceedingly well. And that is why Nifty Next 50 was one of the better performing indices in the market. It probably did better than the Nifty also. Today, if you look at it in the last 4 to 5 years, courtesy some of the Nifty Next 50 names graduating towards the Nifty, we have seen the constitution of the Nifty Next 50 changing a bit. And today, if you look at from a valuation parameter or the constitution parameter, comparatively, Nifty Next 50 is turning out to be a little more attractive. Now, what do I mean by that? One, if you look at the Nifty Next 50, the concentration of the top 10 names would be close to about 53-54%. While in the case of Nifty Next 50, it would be much lesser, let's say about 40% or so, maybe even less, a little lesser than that. In terms of valuations also, if I look at Nifty Next 50, 22 to 23 times trailing earnings, while the Nifty is 23 times trailing earnings, while the Nifty Next 50 is close to 20 times trailing earnings based on November end data. Dividend yield also is higher, and if you look at the, more importantly, the sectoral concentration, Nifty, because of the fact that larger banks, etc., are part of it, larger tech companies are part of it, we have more than 35% in financial services in Nifty, while in the Nifty 50, while in the Nifty Next 50, it is very well diversified. It's much more diversified. 20% is financial services, 10% odd is in capital goods, 9% is in FMCG, 10% is in power, automobiles. So it's a much more diversified universe where one sector is not overpowering the others. And also from a top stock weight, it is about 4% weight in the largest stock in Nifty Next 50. While in the case of Nifty 50, the top stocks are about 10% odd in the first 2 or 3 stocks. So if you look at the diversification, if you look at the valuation, both are more comfortable today towards Nifty Next 50. It is not to say that Nifty 50 won't perform, but if investors are looking at adding on to their exposure, which is already probably tilting towards Nifty 50, generally the Nifty 50 is the Sensex 30 is the investment which people do. Nifty Next 50 today comes out to be a little more of a diversifier at a reasonable price.
Correct.
And it is also something which can be looked at from an investing perspective.
So another way to look at this perhaps, Chintan, is in periods when the Nifty 50 has outperformed and made it difficult for even fund managers in the active category to keep pace, is when a few concentrated performers have emerged, right? Where, for example, an HDFC Bank accounts for more than 10% of the benchmark weight. You put a Reliance Industries, you put ICICI Bank and a couple more, and you say 3 or 4 stocks, if they rise maybe 10% in the span of 4 or 5 months, you'll have the index that rises dramatically. And so it'll give you a very concentrated performance. I think this is what you're seeing in several indexes across the world. If you take the NASDAQ or you take even the S&P 500.
S&P 500, yeah.
Right? It's the top 5 that account for what, 30% or thereabouts of the weight, right?
Yes, much more. Top 7 account for much more, yes.
Yeah, so therefore, it's about what you're looking for. Is it better to have a diversified index rather than an index where you can have either an outstanding performance because of a few or a bleak performance because of a few?
Yes, so if we look at the larger names and also in terms of ownership, like I said, they are well owned. You will have access all the portfolios. So whichever way you're invested in, whether you invested through a mutual fund or a PMS or an AIF or a passive fund, which is an ETF index fund, typically you will have exposure to the names which you mentioned in terms of the larger names. The next 50, which is the 51st to 100, you may not have that kind of an exposure which you should have given the state of the market and the state of these stocks right now. And it's something where incremental flow should definitely be thought of because of the lower valuations and the diversification benefit which you are getting. And some of the sectors which are present in Nifty Next 50, more importantly, are not necessarily present in the Nifty 50, which is a larger name in terms of the proportion also. So capital goods, you'll have 1 or 2 stocks in the Nifty, but you have much wider base in the Nifty Next 50. Similarly, even in auto, for example, the kind of balance you'll get in terms of the Next 50 is quite good, and even in metals. So one should definitely look at incremental flows in the Nifty Next 50. It will diversify your portfolio. It will add value to your portfolio. And more importantly, you're not adding something which is very expensive or has done very well in terms of even the past performance. It's a neutral territory in terms of its past performance also. Yeah. And that's where it will add value to your portfolio.
Yeah, and we're not talking about either or here. We're talking about a complementary strategy. But Chintan, thanks so much for taking the time. Always a pleasure speaking with you.
Thank you so much, Alex. Thank you.
All right, and that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. This is NDTV Profit.